A bank run is very much a psychological problem. I don't approve necessarily, but I understand why officials want to be circumspect. It could be very damaging to a perfectly healthy bank to start rumors about its financial longevity, and then that can start a run on the bank, and then that's the beginning of the end.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 17th through March 24th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold Krugerrand at just $59 over spot. Next, Valcambi silver kilo bars are just $2.20 over spot per ounce. Pre-65 mixed junk silver is just $1.99 over spot, and pre-65 half dollars are just $2.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have a returning guest today of significant distinction. Dr. Judy Shelton was a member of Trump's original administration as an economic advisor. She was also a potential pick for a governor of the Fed this time and has written her book recently, Good as Gold, talking about how America should prioritize restoring both domestic and international confidence in the U.S. dollar and the U.S. Treasury. Dr. Shelton, thank you for joining us again on Liberty and Finance.
My pleasure. Thank you.
I want to mention today we're recording this is Thursday, March 20th, 2025, and we're grateful for your presence here again with us. Folks, if you didn't see our first interview with Judy, it is on YouTube, Brighteon, Rumble, SoundCloud. You'll find it there. Just search Liberty and Finance, Judy Shelton, and it'll pop right up. And we ran out of time in our last visit, and we're likely to do so again today, so we'll try to get right down to business. One of the things we didn't get a chance to talk with you about last time, with all the importance that you have emphasized on backing and demonstrating the solidity or increasing the trust and confidence in the U.S. dollar by backing it, for example, with a gold-backed treasury. What do we know about the actual gold possessions of the United States? We're told that, for example, the gold holdings haven't truly been subject to a full audit since the 1950s. There have been arguable other attempts to have show and tell opportunities or someone check on it and say, yes, it looks like it's there. But what we're told is that it really hasn't been a complete and extensive audit of all the holdings, both at the Fort Knox facility as well as perhaps at the Fed or the Treasury or wherever since the 1950s. What's your view of the status of whether we know how much gold the U.S. actually has and what we should do about making sure that we do know if this is about building confidence?
I think that's key, building confidence. And while I am not overly skeptical, I feel rather confident that the gold reserves would be there as indicated. And I say that based on both former Treasury Secretary Steven Mnuchin's assertion and also our current Treasury Secretary Scott Bessent. They both attest to the gold being there. Nevertheless, I think from a confidence point of view and frankly from a public interest point of view, I think it would be marvelous if President Trump and or Elon Musk verified it. They both talked about doing that. I think it would be important to have some kind of emissary from the Trump administration, do it in a very public way to generate interest. I think to remind people that gold was always part of the strength of U.S. currency, and to trace a little bit of the history. I think that would be very valuable. From an accounting and audit point of view, I would want to know not just that it's there physically, and not only at Fort Knox, but the other locations. I would want to know that there are no encumbrances. And I say that because there are some people concerned that, for example, the Bank for International Settlements or other international banking organizations, there might be some arrangement where the gold is pledged in some way. I'm not aware of any specifics, but I think that's equally important.
One of there are several theories flying around about why it's been so long since there's been, why are we 70 years or so down the road from a full audit of the U.S. gold holdings, and why hasn't it been revalued? You discussed the potential for revaluing the gold either mark to market or some other strategic approach in our last interview. And folks, you don't want to have missed that. You need to go check that out. It's fascinating. But one of the things that's happening at this time in history is unprecedented flows of physical metal out of the London Bullion Metals Association, LBMA vaults, both gold and silver, concurrent with that, unprecedented delays in taking physical delivery from that source, usually 1 to 2 to 3 days. Now it's 6 to 8 weeks for larger deliveries. And we've also been told that a lot of that metal is coming across to the New York COMEX warehouses and going in and out meaning physical delivery, which is also at unprecedented levels for the past several months. Do we have any perspective that would help explain this unprecedented phenomenon and whether it has any correlation with this anticipated potential taking a closer look at the U.S. gold reserves?
Well, it's interesting you ask that. I was asked 2 or 3 weeks ago by a colleague who does regularly advise on economic matters, members of the Trump administration. And he wanted to know, what is the explanation for those noticeable inflows of gold? So I did do some research, but my preliminary response was that, well, there's theories out there that if President Trump is going to do a walkthrough at Fort Knox, that it would be better to replace gold that might be missing, and that was somehow an explanation. And I said, I see that on the internet, people speculating that indeed it's just, there were even little memes. I'm not sure if Elon Musk retweeted it. He might have, showing bricks being spray painted gold in a hurry. So I think it's I don't believe that, but that was one theory. I think the more factual reason is there were heavy imports of gold to the United States last month because of demand for investment in gold ETFs, exchange traded funds, ones that require physical delivery of the gold. And so there's some aspect of it, of whether or not tariffs could be in the offing for precious metals. And so some people anticipating that, I suppose, could have bumped up their demand for gold. But I also think on a global basis, and a lot of these numbers come from the World Gold Council, excellent website, is central bank demand. And that is another reason that we see the price of gold going up. Not our central bank, but that could explain worldwide the increased demand and accordingly an increased price for gold in recent weeks. That's continuing.
Wanted to also ask you a question about something that we've been concerned about, and our viewers and subscribers have been concerned about for some time, and that's the implications to an ordinary depositor of the Banking Act. It has a longer name of the Consumer Protection and Something Act. Usually things that come out of Washington have names that seem oddly opposite of what they are seem to be actually written to do. But this one, the 2010 Dodd-Frank Act, supposedly was to protect the taxpayers from being on the hook for bank bailouts should they be needed in the future, as happened back during the global financial crisis of 2008-9. And in this case, that depositors' funds could be tapped to underwrite or to help the bank with their operating needs in such a situation called a bail-in, but that the deposits would no longer be the actual legal under legal title ownership of the depositor, but instead are unsecured loans to the bank by the depositor. And my contention and the belief of most of our viewers is that most people are still operating under the traditional understanding that it's as safe as money in the bank, meaning what you put in there is in there. Understanding, having watched It's a Wonderful Life with Jimmy Stewart once upon that they do make loans against those and that sort of thing, but that the idea is that it's still you have title to your deposits to be returned to you. Others have asserted that nope, the 2010 Banking Act says you're just an unsecured depositor, and that in that sense nothing in the bank belongs to you. Do you believe that that's a true summation? Is that statement, nothing in the bank truly belongs to you, is something that people should let sink in, or is that a misunderstanding? And can you set us straight on that?
Not sure from a legal clarification point of view that I can be terribly helpful. I actually got in hot water during the nomination process because on the detractors on the Democrat side said I was against deposit insurance, and that would undermine the U.S. banking system because people who keep their savings in a bank wouldn't feel safe. What I had actually written in Money Meltdown, so that was my 94 book, out of, 300 pages, I think I had a half page talking about moral hazard and trying to explain that people need to understand when they put money in a bank, it's not like putting it in a vault and saying, keep it for me until I need my cash back. Because then you'd be paying them. You'd be paying them the storage.
Guard my stuff for me, yeah.
Right. Instead, they are putting your seed money at risk. And the whole idea of financial intermediation is that bankers are good at analyzing good credit risks, and that they are able to invest the money better than you could, have a better risk-return trade-off, and they feel confident that they will not only receive back from their investment, loaning to someone, the amount to cover your part of it, but to make a profit doing it. But fractional banking is exactly that. And we don't have a 100% reserve requirement for banks. So your money is at risk. And then that brings up the idea of then what does it mean to have a sticker on the front window that people grew up with saying the FDIC, the Federal Deposit Insurance Corporation, guarantees your deposit and usually up to some limit. And the limit could be changed. There's not enough money in the FDIC to cover everyone's deposit. But then you have the connection to Treasury and ultimately the lender of last resort. So if there were a massive bank run, instead of a sporadic one, where maybe there's enough funds to cover a bank here and there. So a run on a bank is a serious matter, but until it's widespread, and then at that point, the reserve requirements for the banking system were kind of the protection. And that was accomplished through the Federal Reserve. Currently, there are no reserve requirements, but there are more than, quote, ample reserves, according to the Fed. And in fact, the amount that banks keep in cash is a greater percentage now of their deposits than under the old reserve requirement system generally. Transactional accounts had about a 10% reserve requirement. So I guess I would say that FDIC protections are still your best bet. And sometimes when they dissolve a bank, and I think that's what you were referring to, under Janet Yellen, they might decide to insure people who technically weren't entitled. That is, they might do the big CD holders, and they might say that other people will get paid off. But I think those are bank specific, related to a specific event and how the Fed and Treasury want to address it. And then that also involves FDIC and sometimes the Office of the Comptroller of the Currency.
It's certainly the case when Janet Yellen was giving testimony about following the failures of Silicon Valley Bank and Signature Bank and a few others back at the end of first quarter of 23. When being questioned by a U.S. representative from Oklahoma, he was turning it around and saying, well, these were regional banks and their depositors got bailed out to their full deposit, even though it was far exceeded the FDIC insurance limits, rather than bailing in as the Dodd-Frank Act enumerates. And he said, are you going to do the same for my community banks in Oklahoma if one of ours goes belly up? And her testimony kept coming back to, well, it would be handled, as you said, on a case, we would evaluate based on, and she started naming the parties who would do this evaluation, make this decision based on systemic risk. We judge systemic risk, which I think is significant also, that most people aren't aware that there's actual systemic risk in the banking system, and that if the decision was made in the first quarter of 2023 to go above and beyond what Dodd-Frank allowed for in bailing out large depositors because they perceived risk to the banking system, that raises the question. And again, back to your question of confidence, you're talking about confidence in the Treasury, confidence in the dollar. What about confidence in the banking system? If they felt that they had to deviate from the course that was laid out in law by the Dodd-Frank Act because of potential risk, systemic risk to the banking system?
Well, I would just say at the time, I thought that Janet Yellen was close to setting a very dangerous precedent, because people might well ask, if you're bailing them all out this time, then why wouldn't you do that for other institutions? And I think she deliberately kept it nebulous, because can you imagine if you had a more generalized run, the liability then for the government would be massive. And I think that she wanted to keep it on the basis of, well, there are many factors, and it can also include bringing in, say, a JP Morgan or Citibank or other partners, and whether they can purchase part of the bank and what price. And I think the Fed and Treasury and the parties involved would rather have the flexibility to not be committed for the same kind of bailout for one institution as another. I think buyer beware. Maybe that's what came up as a result of a bank going belly up. But I appreciate, even when the senators quizzed me and said, if depositors can't be sure that their money's protected, how can we go on? And I found myself during my own hearing having to explain over and over again that we do have an FDIC, that I was talking about moral hazard in a theoretical sense, to make it clear that unless the owners of the bank are wholly involved in bearing the responsibility, kind of from a Lloyd's of London type view, that it's their own wealth at stake. When you have the government guaranteeing the solvency of an institution, you run the risk of having to bail out everyone. So I think everyone just breathed a sigh of relief that it didn't go further, because I also think that because the Fed now uses this ample reserve approach and pays banks a fantastic fee. I mean, they're continuing now, as of yesterday, to get 4.4% return on a cash deposit at the Fed, and there's a total of $3.4 trillion. That money's not going down, it's actually increased. So I'm just talking about the commercial banks are keeping $3.4 trillion at the Fed in cash. And I think for a while the Fed acted as if, well, that's better than reserves. That's cash that helps provide safety to the whole banking system. But in fact, I think that banks would be loath to give up that cash account earning that kind of interest rate. I think they'd rather call in loans before they would give up that particular way of earning money, because that costs them virtually nothing. And so they get that great return. I don't want that to be tested either, to see if the Fed could say to these banks, well, you have so much cash, now let's use it to bail out the system.
Well, this all is rather intriguing because when you think about who's being protected and who's being left exposed, it can make it look like the same parties that got hurt the worst in like the 1929 crash, when there were farms being foreclosed on, small businesses being foreclosed on, homeowners, mortgages, people losing their house, their land, that sort of thing. It seems like the ordinary moms and pops in Main Street, USA, are the ones who are considered, okay, well, if they're at risk, well, that's one thing. But if the banks are at risk, we better make sure the banks are protected. And I can understand how I could even, if I were a PR person for a bank, I could spin that around and say, well, it's in your best interest, everyone, Mr. Public, that the banks and the banking system stay up and running. So you want us to take care of ourselves and take care of the banks, because you want that system not to come crashing down, because then everybody gets hurt anyway. I wonder if this is part of that moral hazard you were talking about. Can you give us your thought about that, about this prioritization of good enough for thee but not for me, in terms of who's really going to get protected here in case of a real stress and strain on the banking system?
Well, it's not a picnic for the bankers either. You can get into whether the leverage ratios and the capital requirements are appropriate and adequate. But when, for example, in the early 80s, when Paul Volcker was trying to control inflation, and interest rates went up to 18-19%. And the banks have to start, they see things collapsing. And this is when, your farms or your small businesses, they can't pay it. But as things start to go belly up, from a banking point of view, they have to look at their extended loans and say, are they solvent or just illiquid? If it was a bad loan that was never going to generate enough to pay back the bank and then enable the bank to make sure depositors are paid back. And of course, they have to deal with the timing on that. A depositor could ask at any point for their cash back, but they have to try to match the length of maturity on the loans to being able to respond to depositors on average. It's very difficult, and the real sad thing is if it's just a matter of a good loan, but the bank needs the money now to pay people back, and so that's when you have to call in loans that it's not the fault of the borrower, but it's almost not the fault of the bank. There's just a liquidity squeeze, and they have to call it in before maybe it has generated the profits that it was anticipated to be able to generate. So, I think it can often just get down to the legalities of what is your standing, what kind of account do you have at the bank, and again, whether you're protected by the standard FDIC protections or whether you're a more sophisticated investor. Some investors have been demanding the higher returns that banks have been getting on their own cash accounts at the Fed and saying, look, take a fee, but pass that on to me. But surely there must be some kind of adjustment, because now they're sort of participants with the bank, and the bank is not protected against changes and how long the Fed would be paying those rates and whether they'll continue to pay interest on reserves. So I think it's a legalistic matter until it becomes more generalized. But for now, it's almost on a specific bank basis. And I just say, know your rights. And each person has to decide their own tolerance for being exposed to bank risk.
It was rather sobering to see some of the fine print of the terms of the FDIC insurance that make it appear as though when people might assume that don't worry, you're covered. And then as it says on one of those insurance ads, it's a humorous ad, you go to page 42 and does it say, don't worry, you're covered? No, it says blah, 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 blah. That in the fine print on the FDIC coverage, there is some wording that seems to indicate that you may have to wait 3 or 4 years to be made whole in the case of a bank being taken over by the Fed or that sort of thing. And so or by the FDIC. So it seems that it's not always, it won't be like the bank folds up on Friday, but you'll have all your money back in your sum account on Monday or something. People might be whistling past the graveyard if they think that everything's going to be restored immediately. Just because there's coverage doesn't mean it's going to be immediate restitution. I don't know if you have any comments on that before I move on to the next question.
No, that's a fair comment, but no, I think I'll let that stand.
All right, that's fine. There was also some attention when what was reported to be a leaked video from a FDIC meeting had a speaker saying that there will be bank runs, but we should inform the parties who have the need to know, but not announce this to the general public because to avoid unintended consequences, I believe is how it was said. And what it reminded me of was when you were telling the story of the conversation where Janet Yellen versus maybe was it Alan Greenspan are talking about the definition of stable prices and whether it's 0% inflation or a stable rate of inflation. And this notion that, well, at least when the poll was done for economists, wouldn't have wanted that, but the average worker said, yeah, they'd like small increases, even if it was only nominal, et cetera. It gave me this similar thought process on this as far as if there were going to be imminent risk of bank runs, that the parties with the need to know would be informed, but not necessarily the general public. Any thoughts from you on that principle that people should be cognizant of when deciding how much of their life savings to leave in the bank, et cetera, as far as that goes?
Well, I would say the commonality there, because when you and I were talking about that meeting that took place, it was in July of 1996, and you can pull out the transcripts. It was in deciding the definition of stable prices. Mm-hmm. First, Greenspan took that to mean a zero rate of inflation, versus Janet Yellen said, no, I think low and stable inflation, but it could be 2-3%, because it's a psychological matter. So let me just say this. So the psychology that she was referring to was the idea that people don't want to see a decline in their wages, the nominal amount, the actual number of dollars they get paid. But if you have generalized inflation of, say, 2%, you could give your people a 1% increase in those nominal wages, and they would feel good about it because somehow they wouldn't realize that they're actually down in terms of real purchasing power 1%, because their real wages have to be adjusted for the higher rate of inflation. And she said it's for psychological reasons. Now, I'm kind of arguing the other side just in saying this. A bank run is very much a psychological problem. I've seen one going back decades. When I was at the Hoover Institution at Stanford, a trip into San Francisco one day in Chinatown, there was a run on a bank. And to see people getting slightly aggressive and nervous and pushing and shoving by the hundreds in a line that wrapped around the block in front of a bank and being barred from entering only so many at a time is kind of a frightening thing. And as people went by, they said, what's going on? Oh, the bank is having problems. It's funny. Just the other night, my husband and I watched a rerun of Noble House by James Clavell. And in that, takes place in Hong Kong. But someone was selling the shares of a bank short. And then that rumor got out. And then there was a run on that bank. So the psychology, I'm not saying that excuses in any way the way people are treated, but I think you started out by saying that they didn't want certain information to go beyond, let's say they didn't want perfect transparency. And I think with Silicon Valley Bank, it was rumors that then flew on phone lines and the internet that there was a problem with the bank. And I think the bank was heavily invested in treasuries, trying to emulate the Federal Reserve and keep them happy, but in fact they had significant losses in their portfolio, and I guess that endangered their level of capital. But word got out fast, and then there was a run. So let's just say I don't approve necessarily, but I understand why officials want to be circumspect. It could be very damaging to a perfectly healthy bank, as it was in the novel and in the movie. Very damaging to a perfectly healthy bank to start rumors about its financial longevity. And then that can start a run on the bank, and then that's the beginning of the end.
It sounds like there's a little bit of an analogy there, maybe to like the reason mustn't shout fire in a crowded theater or something like that is sometimes fomenting a panic and getting us all into our reptilian brain where people do this fight or flight thing can create the problem it was trying to warn people about or increase the chances of it. So it's an interesting thing if the whole system is based on everyone staying calm and remaining confident in the functioning of the system, but also informed consent. I mean, properly aware of the risks that are being taken on their behalf. And I still have the gut feeling that there's not sufficient, on average, awareness on most people's part of the risks that they are consenting to when depositing in the bank, or maybe to the level that they are, that kind of thing, or thinking that certain types of products in the bank are therefore not subject to, whether it's savings accounts, checking accounts, safe deposit box contents, certificates of deposit, or money market funds at their brokerage account. I would imagine that people have all these different assumptions and presumptions about the relative safety or risk of all these. And then, of course, the statement always says, read the prospectus before, and everybody goes, I'm unqualified.
No, but people should not be infantilized. Now, there is a Consumer Financial Protection Bureau, which maybe you were alluding to before. I don't like that particular organization. It's housed within the Fed, financed by the Fed, even though the Fed is running an operating loss. There's quite a bit of activity to shut it down, or very much. I guess the latest approach is to limit its purposes, but to prevent it from doing things that it had no business getting involved in. But my objection to the CFPB has been that they do infantilize perfectly functioning adults. And I think when people go into banks and say, I want to borrow money, I don't think it's appropriate to then later say they didn't understand that they had to pay it back, or that it was all because of the greedy bankers. I presume both sides of the transaction are fully aware, do read page 52, and are financially literate. That is, I think it would be healthy for depositors not to be treated as victims. Now, if they are subjected to criminal behavior, if there was misrepresentation, if there's fraud involved, then of course you have to pursue that. But I don't think anyone should say that when I put my money in the bank, they're just going to keep it in a little safe. It's being invested. It's being invested. They are financial intermediaries. They are in between the people with financial resources and the people who need financial resources. And they're the ones taking your deposits and turning them into loans and investments that are inherently risky, although some portion will probably go into treasury debt. Increasingly, I think banks don't mind playing footsie with the Fed and just getting paid on keeping money in cash or putting it safely into government treasuries that are all government guaranteed. But you can't have capitalism without risk. It's the classic risk reward opportunity, and I think the only way you generate a higher standard of living and bring about true increases in prosperity is to provide financial capital that is at risk for purposes of the greater harvest in the future. That's how we move forward. And banks used to be the best way to do that. What's sad today is the small and medium-sized businesses that used to be so powerful a component of capitalism are having to go elsewhere than banks. The banks have been absorbed into financing the federal government way too much. And they're having to go to non-financial institutions who they may turn around and get the loan from the bank. But then that puts the actual loans out of the regulatory lens and focus of Federal Reserve Bank examiners. So I don't know if that's going to get tested one of these days, but over half of the loans are being made by non-financial institutions today. Sorry, I said non-financial, I mean non-banking. They're not traditional commercial banks.
Yes. On a future time, we'd like to follow up further on like Jerome Powell's recent statements just this week that the Fed may not be able to achieve its stated 2% inflation target, even after that conversation with between Greenspan and Powell and Yellen once upon a time. Now at 2% inflation target until like 2027. So what the world is likely to look like that most people can adjust their expectations. And just this idea of if banks are intermediaries of risk for people to be able to invest through the bank in order to get some yield themselves and that sort of thing. What about insurance companies? What about pension plans? What about all these other types of things? And what kind of risks people may or may not be aware of that those are being subject to in the current environment? And if those entities are basing their stability on treasuries, and that's dependent on foreign treasury holders, et cetera. So taking a look at that risk picture and a broader aspect outside the banking system as well. So we'll have to get to those questions later. And we're grateful, Dr. Shelton, for your presence here. If people want to find your book, Good as Gold, any tips on where they should go and what forms they'll find it in?
Amazon, hardcover, Kindle, audiobook. You'll find it on Amazon, and I think it's in their bestseller list. That is the top 100 for 3 categories: for money and monetary policy, for economic policy, and for economic and development policy. So it's pretty easy to find on Amazon, or I think you can go to the Independent Institute. So I believe they also have a way to purchase the book. So I'm happy if people are interested in doing so. Any royalties go to Independent Institute because they suggest that I write the book, and so I appreciate that. I still had that book left in me 30 years after Money Meltdown.
Well, thank you very much for having written it. It's been a fascinating edition. I think it's gathering a conversation that is good and healthy for us to have, and hopefully will result in some thoughts being aligned along those lines and hopefully action being taken in that direction. We're grateful for your presence here on behalf of all of our viewers and subscribers here at Liberty and Finance. Thank you, Dr. Judy Shelton, for joining us again.
Thanks so much for having me. My pleasure.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 17th through March 24th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold Krugerrand at just $59 over spot. Next, Valcambi silver kilo bars are just $2.20 over spot per ounce. Pre-65 mixed junk silver is just $1.99 over spot, and pre-65 half dollars are just $2.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.